Okay, good morning and welcome to the Gulf Intelligence Daily Energy Markets Commentary, where we gather to review the opening in Asia and look ahead to the day in the Middle East and Europe. No better place to start whenever we can on a Thursday morning, but in Asia with Vandana Hari, who is the founder and CEO of Vandana Insights. A lot of noise coming out of Asia today over the last few days, over the last weekend since we last talked, the Great China National People's Congress and all of the subsequent fallout now we're seeing as the US week gets fully underway. The face-off between China and the US is becoming quite ingrained. I'm wondering, what does it look like from Singapore, Vandana, and is it something the markets need to keep an eye on?
Certainly, Sean. I think it's very concerning for the markets, not just in this part of the world, most certainly in Hong Kong, but globally, the financial markets appear to be quite rattled again at the prospect of this political tensions between the US and China now spilling over into the trade arena. And as we all know, the phase one trade deal was in itself a bit of a damn squib. It's quite fragile. So I guess the fear now is, as we come out of this pandemic and the countries begin to revive their economies very, very gradually, what would another outbreak of a war, a tariff war and a trade war do? So that's definitely a big concern as far as demand recovery is concerned. It is doesn't look very good for the oil markets.
Well, from what had been a fairly bullish run for some weeks, there was a lot of consideration as to what might be the trigger to reverse the momentum of this market. Perhaps these consolidating positions on China and the US may be the sort of sobering moment. Kevin Wright, lead analyst with APAC for Kpler. Kevin, welcome back, and welcome your opening thoughts on the markets here midweek, and particularly following on this point regarding China.
Yeah, good morning, Sean. Thanks very much for having me back on. It's a very interesting point that Vandana raises there, that the ongoing spat threatens the sort of fledgling recovery that we've started to see over the last few weeks. I mean, Chinese refining runs and Chinese imports, from what we see on our data, are very strong. Last week, something like 14.5 million barrels of crude were imported. And that's not necessarily going to demand, that's probably going into storage. But the point is that clearly there's a little bit of industrial activity recovery in China. So to see the renewed spat, to see the ongoing sort of barbs, whether it's Twitter and fact-checked or otherwise, is a little bit disturbing, as Vandana says.
It's certainly, one would say, slightly moved beyond a spat and now is consolidating into policy, where we're seeing the potential of bringing in Rustin Edwards, our third speaker, head of fuel oil procurement at Euronav. And I know geopolitics maybe not your specialty, but nonetheless, we are getting into a place where the consolidation of rebranding Hong Kong out of its privileged trading status, whatever the correct language is for Hong Kong, and the potential for sanctions does start to move this, Rustin, into a different category of spat to potential full-on trade war, call it what you will.
Well, I mean, it is, you know, if you look at the resolution that was passed by the Congress yesterday for the potential placement of sanctions, it all has to go back to the Uyghurs and the way that they've been treated by the Chinese government, you know, basically using human rights violations as a way to lever China activity and probably to poke back at China over the whole COVID-19 debacle, with all the countries having their issues that they've had on reporting information and data. So, I mean, sanctions aren't good. You know, they do curtail world trade. I mean, it depends on what the level of the sanctions are and who they actually sanction in the process. I mean, if they go after, you know, secondary people within the Chinese government, It may not impact things as much, but it just reshuffles the deck as to where flows go. I mean, from a crude oil perspective, China can still buy from, will probably still purchase from Northern Europe, Middle East, West Africa, and probably avoid the U.S. crude. And if China pulls from those regions, U.S. crude will come and backfill into the European refining basin. So, I mean, it'll just reshuffle the deck. It'll take a few weeks for it to happen, but it will happen. So from an oil flow perspective, I don't think it impacts it too much.
Well, what else would you look at, Rustin? We're obviously seeing refining margins very, very tightly squeezed, in some cases into negative on the back of this surging oil price over the recent weeks. That's knocked on to impact freight rates. How do you see that playing out?
Well, I mean, as I've said before, this whole recovery has to be demand driven. It can't be supply pushed. And so even though there's been a lot of enthusiasm, financial trading going back into the crude futures and basically boosting the price of crude forward, because the majority of the buying has been from funds or from non-physical players, let's call them, you still haven't had the actual gasoline distillate demand pick up yet. And we'll probably start seeing that pick up from this point forward as more countries get out of lockdown and people are getting out in their cars and driving more. And we'll see what next week's stats look like with the EIA information from Memorial Day come flooding in from the United States. And yes, it was a subdued Memorial Day, but still, from the pictures you see from different regions in the United States, people were out and about. So we might see that start pick up that green shoot of demand start flowing into the markets, which will actually increase the refining margin. But until that actually happens, it's not going to happen. I mean, the API data was rather, it reflects back to that, yes, built crude and we built products because the demand isn't there yet.
Vandana, the other story that came out overnight, which is in the Daily Digest, is the report from the IEA on investment, capex investment, and the lack thereof, if you like, a sort of bionic number of a $400 billion decline in capex investment in 2020 across the energy value chain. What's your thoughts on that, the impact, the outlook for that going forward, and also with the OPEC meeting coming up next week?
So the $400 billion figure, indeed, as you say, is quite staggering. And it's happening across energy. So that is a total for the energy sector. But oil, of course, has a big chunk, and oil is dropping oil investment is dropping in a big way. I think that should not come as a huge surprise to anyone, though every time you see a figure like that, of course, you do a double take. There are worries, of course, at the back of the minds of policymakers, the industry, of course, and right down to the man on the street. What does this mean as and when demand does recover? Okay, maybe it doesn't happen in 2021, perhaps in 22. As global demand recovers, demand growth comes back, and then we find ourselves in a world where shale is but a shadow of its current self or former self. We have a lot of Russian old fields and wells that have been closed, that perhaps are not able to come back online. And just overall, projects are being cancelled, being put on the ice. So we once again find ourselves in a world where growth is moderate, let's say, even if not very strong, but we just don't have enough spare capacity, and we don't have enough supply. I think that's a very, very real fear. You asked me a double-barreled question, so
yes. Well, I think that the triggering of the connection there ultimately is that if we are seeing a $400 billion reduction in capex investment, which is ultimately a large slice of that goes into new supply, and then we also have OPEC a meeting next week to consider continuing their reduction and cutbacks over the coming 6 months. Does that affect the fact, or what do you see, any correlation or an expectation for OPEC?
I think for OPEC meeting, I think they are going to be very heavily focused on what, if any, recovery, sort of rebalancing in the market that they're already seeing. Of course, there's not going to be a whole lot of data because it's just the month of May that they'll be able to see in terms of their having started their production cuts. They're going to do some projections on demand going forward. There seems to be quite a bit of unanimity around the global demand and supply balancing around June, July. So perhaps there'll not be much differences around that. I think, however, and I think these are part of the market fears that are playing out today, over yesterday and today, that could we see yet another rift? There have been ideological differences between a dovish Russia and a hawkish Saudi Arabia, and we saw that play out to its full extent on March 6th, as everybody will remember forever. And the past couple of days, there's nothing very concrete as such, but the market has been reading a little bit in between the lines and thinking that perhaps Russia is veering towards a dovish stance again. So, do they decide to roll over the 9.7 million barrel per day cuts of May, June to the rest of the year, which probably I think is what the Saudis and their OPEC allies will prefer. Perhaps Russia veers towards, let's pare it back to 7.7.
I think on that point, it's hard to, Kevin, to bring you in, it's hard to identify a solid reason if you were trying to convince the Russian president or oil minister as to why they should abandon the plan that they agreed only a month or more ago, i.e. we agreed to move from a 23% cut to an 18% cut from July. Why should we abandon that and stick with this more austere cut through the second half of the year? Do you have a case to make for that?
I think it comes back to Rustin's point a few moments ago, actually, and that's that any alteration in the cut is premature because we need to see solid demand recovery before that happens. If we don't see the demand recovery, then I think an easing of the cut potentially. I mean, things are very, very fragile. So an easing of the cut potentially starts to turn prices south again to where we were, 2-3 weeks ago. So I don't see why, personally, I don't see the argument for easing the cut being very strong.
Yeah, it will maybe to prop up prices so we can see Matt Stanley run down Sheikh Zayed Road in his birthday suit. Apparently that's on the cards. But Matt, until then, can you give us a market update this morning?
Morning. It's a chicken suit, just to
sorry. Birthday and chicken, they sort of go hand in hand, but chicken, okay.
That was a mistake. We're down 50 cents this morning, Brent, and Brent's expiring tomorrow. Look, I agree with all three panelists. The rally cannot be sustained purely on curtailing supply. There has to be some tangible data that demand is back. API stats last night said that there was a 9 million barrel build on crude stocks, million barrels on gasoline, and we're supposedly in the first week of driving season with the Memorial Day weekend. So unless something really comes out later on from EIA, I think we could be testing low 30s before the week is out.
And given the momentum that we've seen in recent weeks and coming out of the holiday weekend, we had some of that momentum, whether not necessarily data, but sort of anecdotal evidence of packed beaches and airlines announcing plans to restart and so on. Why was that not sufficient to keep the momentum going until a data point arrived?
Well, I think people are just generally being more frugal and more conscientious when it comes to spending. They might be getting on a bus instead of going to buy a new car. They might be sharing, just generally being more economically efficient. And just because lockdowns are eased doesn't mean that people are going to go out and going to go and buy a new car or fill it up with the latest high octane gasoline. It's people's spending habits will change, and I think that will be reflected in weak demand throughout the rest of the year.
Rustin, what's the situation in your space in terms of, we obviously have talked over the weeks about floating storage and the demand for tanker vessels for those purposes and so on. Where is the outlook for that space at the moment?
Well, I think from most of the data that I've seen, a lot of the floating storage has yet to liquidate. It's still there. So even though we've had this incipient demand in the front That's driving up crude prices, moving the Dubai curve into backwardation, premiums spiking up higher. It's still not enough to pull barrels out of storage, either in tank or in floating storage, to fill any demand needs. So you're in this weird market where you've got a prompt backwardation on the cash physical barrel, and you've got a structural contango. Without the, going back to the demand, without the actual real demand to drive product runs and increase refinery runs, there's no need to see the curve invert or flatten out any more than where it currently sits. Currently right now, does it pay for floating storage on Brent? No, it doesn't. It's actually, it did get a little bit weaker yesterday on the sell-off with the API stats, but it's still not there to cover most people's operating costs. So it doesn't really make much sense from a trader's point of view to take on a floating storage position. Now, from the product standpoint, there is still significant structure in gas oil and 0.5 fuel oil, and that can still cover floating storage economics. So it's a more products are oversupplied more than a crude oversupply, and that's being reflected in the forward curves.
Vandana, we've kept an eye on this program over recent months, points of evidence where the China-US face-off manifests itself into possible proxy trade wars and so on. In the digest today, we've got two examples of that. One is in Israel. There was a project, a water treatment plant that a Chinese company was set to win and then lost because apparently of American influence not to give it to the Chinese. And then also in Australia, where we're seeing pressure possibly on the Australian currency because of punishment on shutting down coal imports. I'm wondering, just on that trend line, how does that outlook look for you? Is it something that we should keep an eye on? Is it market relevant?
I think it certainly is, Sean. Politics, geopolitics is as relevant to the oil markets as is the economy. So you're quite right. While US-China tensions are right now front and center for the global financial markets, but there's tensions developing with vis-a-vis China in a lot of the other parts of the world. So Australia obviously is one of them, and it's not a very good thing for Australia because it's very heavily dependent on revenues from exporting raw materials to China. And I was talking to a client and a contact of mine in Australia. It's very interesting. He was saying that, however, the mindset in Australia is changing as well. It's not about how can we get back to normal relations with China and when can we start flooding their markets again with our raw material. Australia is now starting to think about how can we move up the value chain ourselves, instead of just depending on the Chinese market. I think globally, the countries that have deep pockets, the ability to take sides will probably take sides. Some will be forced to take sides, as you were just saying in the example of Israel. So probably when we talk about the new normal, I don't think this sort of transitioning out of pandemic is so much a new normal as is the completely new geopolitically realigned world that we might be coming out in. And overall, I think China is the second largest oil consumer, and we heard from the Chinese parliament over the recent days. China has to have a completely new playbook for its economic growth now. It is saying very clearly we can't go back to just dumping money into infrastructure. We can't go into just boosting our heavy industry. So all of that tells me that we might have moved past the peak for Chinese oil demand, at least, if not the global oil demand.
Kevin, on that point, one of the sort of outcomes appears to be of this great pandemic crisis and the oil bubble within that crisis, but that we had in our interview this week on Halftime Talk we did with Sarah Akbar, the CEO of Oil Serve Kuwait, and her comment was that the pandemic has accelerated the future forward. We've basically skipped 20 years. The China-US relationship was always going to end up in a full face-off, and it's just accelerated it to that point. the adoption of digital and all of this Zoom and remote working and a variety of other things that have accelerated the future forward. I'm wondering, would you concur with that viewpoint, and how do you think it plays out?
I think it's hard to disagree. I think, Matt raised a very interesting comment just a moment ago, talking about people being more frugal in the future, people being more careful about their spending and about their activity. Now, I don't quite agree with him that they'll be getting buses instead of cars for obvious reasons, but I can see that people are going out less. And I think we are going to see an impact. There is no question that people's behaviours as a result of the pandemic are going to change. People won't be in restaurants and bars and so on without thinking about social distancing, without being aware of proximity until there is some sort of credible, plausible vaccine. And I think that's the sort of short-term impact. And if you look at developments, like you say, changes in working practice, working from home, we're all sitting here on Zoom communicating pretty effectively. And I think that's being seen around the world, that you don't need the same level of office capacity. Therefore, you don't need the same level of transportation.
What about, so does that add up, Kevin, from your point of view, and this is what Sarah's perspective was, that it's also accelerated forward peak demand, that maybe it's now in the rearview mirror rather than in front of us?
I think it's a strong case. I think that's a strong case. Yeah. If you, as I say, if you look at the combination of technological advances that we're seeing over the next, 5 to 10 years, I think the pandemic has accelerated that peak demand to almost being behind us, arguably. And yeah, the forward situation is just a further decrease in consumption.
Rustin, speaking just more anecdotally on a personal level, you sit in Switzerland. What's it like in Switzerland? Obviously, we're seeing Europe open up. Switzerland seemed to manage this crisis quite well. What's the outlook there?
We're open for business. We've been open for about 2 weeks now. And from what you see walking around the streets, people are maintaining social distancing as they see fit. The parks are full on the sunny days. Families barbecuing, doing their normal as they would normally in this type of weather, in this type of environment now. Restaurants seem to be full, although, I had my first business lunch yesterday with another trading counterpart. And
business lunch, it sounds like something, your grandfather told me about.
It's a luxury.
There was this thing called a business lunch. You used your credit card from a company who used to pay for your lunch. It was a great idea.
But the restaurant had about I would say 60% of the tables removed to allow everybody to have social distancing. So capacity wise, the restaurants are being full, but they're being full at one third of what they used to have as people. And
right.
That's going to actually impact, the economic valuation of a restaurant.
I've been personally taken by the opposite of how willing people have been to go out and to be in particularly in the US, what appears nearly reckless. I want to bring Paul Young in for closing comments and market view at the Paul, if you're unmute. But that's been my observation over the last few days, has been the willingness of people to run out of their houses and pretty much jump up and down without any regard. Paul, what's the markets you're watching?
Well, I was just making a point there that Asian crude anyway is actually slipping into backwardation, which I just made the point. I didn't expect to use that word for many, many months with all the floating storage that everyone's telling us about. So like the Dubai, which front month will be June, July as a Monday, well, it's effectively is now. But the brokers are quoting that, plus 2-3 cents, so slight backwardation. I expect to see, the market expects to see the new front month Oman contract, which will be trading August against September, the front month spread on Monday. That's clearly moving into backwardation. It could be 40-50 cents looking at it now. We'll have to wait until Monday before we get a clearer indication. So it probably tells us something that these huge volumes of floating storage are actually being refined. So something's happening. We wouldn't be seeing backwardation otherwise, and it's not just like it's a futures contract, the outlier, or a DME contract that's showing it. Dubai swaps are as well. And we've seen, you know, I've mentioned before, China INE has been consistent off $40, August and September. So if you wanted to buy July Oman or Basra Light, which are deliverable into China INE, your sales price is $40. All right, that didn't work at the start of the month because the freight was so expensive. With the freight coming off massively, you know, obviously a lot less crude being shipped, that arbitrage is potentially back on. But yeah, backwardation, very, very surprised to be talking about that. And it's still in May.
Well, things are happening fast, Vandana, and your closing comments and the rest of the panels will also have to be fast to stay within our 30-minute limit. But I'd love to hear your closing thoughts on where you see the rest of the week going.
I think the attention will remain on how this China-US tensions play out. And I think the attention is already now gradually starting to shift to what comments, if any, we might hear from more from the Russian and Saudi energy ministers, and perhaps the other OPEC, non-OPEC ministers. I think the market will be very keen to try and read, as it were, the tea leaves on what might be decided over the June 9th and 10th meeting. And within that overall picture...
What was announced overnight, Vandana, was the fact that Putin and MBS had a telephone conversation.
Yes.
That was announced publicly.
Yeah, I thought that was sort of trying to reassure the market because clearly OPEC Plus might have been a bit worried about the slide in prices over the past 2 days. Some of it because of, as I mentioned earlier, worries about what stance Russia might take. I was just going to finish up with, like, in that overall scenario, I think attention will be very, very closely focused also on the EIA data later tonight. Especially, does it confirm the humongous crude build or not? I think a lot of people have been wondering where that flotilla of more than 40 million barrels of Saudi crude went, you know, which was we've been reading about for the past few weeks. Did it not land on the US shore? So I think there'll be a lot of attention on the EIA data tonight.
Stopped in Jamaica for some few glasses of rum, maybe, seeing out the lockdown in more enjoyable places. Kevin, your closing comments, please.
Yeah, 2 comments really. One around floating storage versus backwardation. It is a puzzling situation. We're seeing a growth in crude floating storage, in particular in Southeast Asia, by about 11% week on week. That's 25th of May versus 18th of May. So that's obviously very recent stats. So the backwardation is puzzling. The other one is, I'm very interested to see what the EIA stats are like today. I think the API sometimes has had issues with its data, and therefore I think the EIA will be much more illustrative of what's really going on with inventories.
They were aligned last week, however, on the drawdown, which was a little bit surprising. I thought the API might have been an outlier last week, but it turned up they aligned with the EIA the next day. Rustin, your closing thoughts, please.
Much to the EIA data, like the other 2 panelists, I'm also going to be looking at crude production in the United States. One of the things with shale is that shale is a very robust oil. With sustained prices of TI over $30, we could start seeing production coming back. And so something to keep an eye on is what is the overall U.S. production level as we maintain these prices.
Yeah, and will it emerge as an issue at the next OPEC meeting that we might see some shale recovery before then, or at least noises about it? The other thing I just wanted to point out is a survey question we've been running online on Twitter about what has been the wind in the sails of this recovery over the last few weeks. That obviously has taken a pause today, but it was interesting to me that 44% responded that it's hope rather than anything else. Government stimulus, yes. Economic recovery, the lowest number, but it's more a hope that the worst is over, wind in the sails. And in order for hope to survive as a strategy, it's got to have some real data, as was mentioned on the call today. Some real demand data needs to come in and embed that hope into something more specific. And if it doesn't, we'll probably see a bit of a slippage here. Listen, that's a wrap for today and the week. Thank you all very much. It was a short week here in the Middle East with the Eid holidays and everything else. So we go into the weekend, have a safe weekend, and we look forward to seeing everybody next Sunday. All the best. And thank you to our panelists, Vandana, Kevin, and Rustin. Take care.
Thank you very much.
You all have a good, safe day.